Thank you all for tuning in. Now, I can't promise you the outcome that you're gonna get from watching this, but what I can tell you, if you apply what you're about to learn, this will change your financial future. If you're here, it's probably because you're ready for change. And what you're gonna learn in tonight's training will do just that. So if taking back control of your money isn't enough to keep you glued to this screen for the next 90 minutes, I think it's time to reassess your priorities. Number one, you're gonna learn how to take back control of your money. And you're gonna do that by learning how to be the bank. Number two, you're gonna learn how to build wealth through your own debts and expenses. And you can do that without working harder, without working longer, and without taking on any additional risk. And number three, you're gonna learn how to get all the money back for every single car you will ever buy, drive, and own. That's exactly what you're gonna learn in tonight's training, so get ready, get set, let's go.
Take back control.
Tuesday night.
Tuesday?
I will be your host, Jason Sipple. Welcome to Take Back Control Tuesday, all. We're going to jump in here in a moment. So, what if by changing one thing, everything would be better financially for your family? How many of you would make that one change? How many of you want more money? That one paradigm shift and new skill is the gap between you and the wealthiest families. It's the difference between being a borrower or being a builder. In the next 6 hours, I'm gonna let you in on a little known secret, a little known fact that the wealthiest families and visionaries like the Rockefellers and Walt Disney have been using this strategy called the infinite banking concept for ages to build and preserve their empires. The strategy is simple, it's legal, and it's something that each and every one of you have access to. And it all starts with changing that one thing. Start loving yourself a little bit more. Start paying yourself first. Because shockingly, we're giving away a big chunk of all of our money every time to the banks, to Wall Street, and to the government. And so would it be okay if I share a little bit about myself and why I'm so passionate about this subject? I want you to imagine this. Imagine that you're in a mastermind and you're part of the leadership and you're doing an exercise about what is your big vision? What are you dreaming about? How much money will you have and by when? And who's going to be around you? Who's no longer going to be around you? What kind of car are you driving? Is it sexy? And all of the things. And everyone's getting pumped up. Everyone's getting excited. And I started crying in that moment in Mahwah, New Jersey. And I looked at one of my friends, one of my peers, Andres, and he was like, "What's wrong?" And I was like, "Man, I'm failing. I'm failing my wife. I'm failing my two boys. I'm failing myself. I'm just failing. I don't have a plan. I don't understand money. I just know that what we're doing here together, it's amazing. I can see the value, but it's not moving me any closer to my goals and to my big vision of what my future looks like." And so I went home, came back to Orlando, city beautiful, and asked a friend of mine. He's a fiduciary with 40 Wealth Management Offices. His name's Brian Reppel. And I called him up and I was like, "B-Reps, I need a financial philosophy." And he said, "Come on over, Sip." And I went over and he handed me a book. And he handed me, I won't show you yet, but he handed me a book. And I'm going to show you guys what book. And I read it that night, a Tuesday night. And don't be impressed. It's only 91 pages, so not very impressive. But I read it again on Tuesday, and I thought what most people think. This can't be true. If this was true, every American would practice this. You know what I started doing? I started practicing it. And within a few years, we went from having negative cash flow of $3,300 a month to having passive income by changing the one thing. So today, I'm going to show you how the banks are making tons of money on the money that you're working so hard to earn. I'm going to show you how you can give yourself a 35% raise by changing one thing, as well as a better way to finance everything in your life, even your vehicles. Now, if you guys could just learn one of the 4 things I just shared, would that be valuable? You know, everything I'm telling you is relatively simple, like my last name, right? Simple as simple. It's relatively simple. but it's going to be a paradigm shift from what you're used to. So while I would say don't believe anything I say, I'd still ask you to keep an open mind and say, if I don't understand this, I just don't understand it yet. Now, as Nelson Nash said, the infinite banking concept is an exercise of imagination, reason, logic, and prophecy. So unless you're driving, I want to do a little bit of a imaginative exercise with you. We're going to close our eyes and we're going to imagine that we're back and we're 18 years old again. We've just graduated high school and I'm up and leading the room, and I'm going to ask you all, how many of you are going to be financially successful by retirement? Before the words even come out of my mouth, you guys are going to be jumping up and screaming, ooh, me, Jason, call on me. I'm going to be the next Elon, the next Warren Buffett, the next Bill Gates. I'm going to be next maybe Donald Trump. We all believe that we're going to be so wealthy because why? We have our whole life in front of us. But then something shifts. It's slow, it's insidious, and it's barely perceptible. Something shifts over the next decades in our life. And this shocking statistic becomes our reality. Now, would you believe that according to the Social Security Administration, only 5 out of 100 people are financially secure in this great country? How's that possible? That sounds ludicrous. That's crazy. We live in the greatest country, in the greatest times, in the greatest technological era right now, and it's getting better every day. There's more wealth now than there ever has been. So how is this statistic a reality? Well, it's because we've been groomed to give up control of our money. We've been groomed to assume all the risk from a young age. We've been taught financially by people who didn't have our best interest, or just by hearsay, or we're just following along. And so, again, today, if you're here, if you want to have a better financial future, make sure you're taking notes. Make sure you're being interactive in the chat. Make sure that you're taking ownership of this because you guys are different. You're already in the 5% because you're here investing your most valuable asset, your money and your time. Because as a great man once said, Will Rogers, the greatest or the biggest problem in America isn't what people don't know. It's what they think they know that just ain't so. Now, ain't that the truth, Will? Or how many of you agree with Will? Does that make sense? And so a few minutes ago, I promised I would show the book that changed my life. And I'll hold it up here in a moment. But there's some other people that you might know about, pretty famous people that talk about this concept. And like the strangest secret, it's been there all along. It's been there for hundreds of years. Why haven't we heard about? There's this one guy, he had a rich dad and he had a poor dad growing up. And he wrote quite a few books that has changed the financial game. And one of them, Second Chance. In Second Chance, Robert Kiyosaki talks about this concept, about using whole life policies as a strategy, as an alternate asset class. And there's the big guy, the guy who changed my life, the guy who had me leave corporate America, Tony Robbins, Money, Master the Game. I owe Tony so much. I've had so many good relationships, including the one with Brian, come from his ecosystem. He talks about this. And then the book I've been mentioning, from the GOAT, in my opinion, Nelson Nash. That's the 6th version. I have the 5th version. This is the one that I usually send to people. Nelson's book changed my life. And I thought what you all thought, if this was true, everyone would be doing this. And what I love about Nelson's book, he shows us the rules of the financial game. I'm taking Nelson's 10-hour course and turning it into less than 90 minutes for you. And he also shows our human nature, which is, for me, that is the greatest thing because it is about our thinking. It's about the real estate between our ears. And then you have my partners, my peers who wrote a modern version of this book called Mapping Out the Millionaire Mystery. Brent Kessler and Chris Naugle, they both live this. We walk the walk. We drink the Kool-Aid. That's their book. We can send that to you. If you're curious about that, just email me at jason@jasonsipple.com and I can get you that book. And then you got Chris's book. He understands better than most that the money has to stay in motion and the banks aren't keeping our money still. And so he wrote the private money guide to kind of show you how you can do business at the you and me level and really know the people that you're doing business with. So let's talk about, remember I said it's about imagination. So let's talk about this intriguing concept, the backwards bicycle. I'm not going to show you the whole video, but I highly encourage you to go, not now, but later, go check it out on YouTube, because think about this. Think about when you were either teaching your child how to ride a bike, or maybe you were learning how to ride a bike. And when you get on that bike the first time, what happens when you press the pedal down and go forward? Or you press the pedal down, you go forward. Pretty simple. The harder you pedal, the faster you go. Now, when you turn the handlebars to right, the bike goes right. When you turn the handlebars to left, the bike goes left. And now you're flying down the street and you crash and you scrape your hands and your knees, you can get up. And all, one, because you just rode the bike for the first time, and two, you can't believe that your parent let you go, mom or dad, or maybe your uncle. You're just like, why'd you do that? Look, I'm scraped. But did you give up? No, you get back on the bike. You continue riding because it's a great freedom. Now, the question, when you look at the neck of the bike in the backwards bicycle example, is what did this welder do? What is that contraption? Imagine if the bike, if you turn to the right, the bike went left, or if you turn left, the bike went right. Now, how many of you think you could ride this bike? I think I could. And all I ask you is you hold your laughter until you see me get off the ground and make sure I'm okay. But no, of course not, because our neural pathways have been set. We have learned how to ride a bicycle one way. And we've been doing it for a long, long time, some of us, right? For me, for 44 years, 45 years, riding a bike. If I got on a bike that didn't work the way that my brain has been programmed, I don't know if I'd be able to work it at first. Eventually, yes, over time. And so the thought here is, what if your money was just like the backwards bicycle? What if all of the things that you think you know about money wasn't true? So hold space for that. And let's jump into this together. Let's start talking about money. And let's start talking about some of the wealth killers of our money. Why aren't more people successful? Why are 95% of people not being financially stable? And I'm going to say it's the two M's. It's going to be the math and the mindset. Now, on the math side, who here doesn't pay enough in taxes? How about inflation? When you go to the grocery store, have your groceries got more expensive? Is our money worth less right now? How about the market? Does the market go up? Does the market go down? All of these are factors on the money side of wealth killers. And finally, interest. And I'm going to show you something later where it's not the interest percentage you're paying, it's the volume of interest that you pay over time. Again, if you don't get this, just give yourself permission that you don't get it yet. Now let's look at the mindset side. I've already said this is where I believe we have the most opportunity. On the mindset side, we first have following the status quo, right? I call these folks the sheeple. Not you guys, but those other people out there, the sheeple. The ones just following along, doing what everyone else is doing, jumping into the market, out of the market, getting scared, buying crypto, dumping crypto, spending everything, being last in line for the money. And then fear. And I think there's only two fears. There's the fear of failure or the fear of rejection. Nothing else, right? Eventually, we're going to graduate. We're not going to be here. We're going to shuffle off this mortal coil. So what are we afraid of? If we learn something, if we're a little bit uncomfortable, that's amazing. That means we've grown. And that's what we're looking for. Then life distractions. You don't know how many people of the 3,000 plus people I've talked to who sounded like in that call, that strategy session, that they really wanted to have their privatized banking system. They wanted to have their family bank of Sipple, or their bank of Lucky Ferguson, or their bank of Arthur Franco. They wanted their own personalized banking system. But then what happens? Kids, life, work, emergency, events. The one constant in life that we can all agree on is what? And now if you might have put, Jason, it's death, you just told us, yeah, no, that's not what I'm talking about. Taxes, nope, not talking about that either. I'm talking about change or an event, right? Financially speaking, events come every 7 to 8 years, have been since like 1910, since the Federal Reserve went into place. And simultaneously, we're all having events. We have good things happen, bad things happen. We have air conditioned units go. We have different things. So we want to build a system that we control. And that's what we're going to talk about for the rest of our time together. Is first, we're going to set some standards. We're going to talk about some of these mysteries of money. And then we're going to go through these examples I promised at the beginning, one by one, so you have a roadmap and you know what to do next. So let's start simple. What is your definition of money? Or money is blank. Money is nothing more than a tool. It's a means of exchange. Money for car, car for money. Money for house, house for money. Money for food, food for money. Know what business uses compound interest. You might have said banks. I think the banks do. Well, you're not wrong, but they don't use it because why? When you go in, think about this. When you go in and deposit money or your money is deposited into the bank, if you walk in a teller and you hand them a $100 bill with your name on it, do they take your magic $100 bill, go back to the vault, open it up and put it in there with your name on it? And then they come back and like, hey, Amanda, here's your $100 bill back. No, as soon as we deposit money, what has to happen? The money has to start moving because money that's not in motion, right, doesn't make money. And the banks understand this better than anyone, which is why it's called becoming your own banker. So that money has to stay in motion. It's just a law of nature. It's like our body. If we don't move our body, we get stiff, we get achy. If we don't, we're not going to drink water or eat fish from a stale pond. We're going to make sure that water is flowing, right? That there's exchange of oxygen going through it. It's going to be fresh. And so this is the same thing. I didn't put up the question. Now, the third question is, are your dollars worth more today or in the future? In the future, I would say, well, let's talk about this for a second. If you think about having a dollar 20 years ago and going to the store, going to the grocery and buying a candy bar, how many candy bars could you buy? Probably at least one, maybe two, right? Buy two for $1. Today, if you take that same dollar, if you held on to it for 20 years and go buy a candy bar, you can't even get a fraction of a candy bar. Not only is it 3 or 4 times more expensive, so our dollar's worth less, but they're giant. They're trying to poison us, right? They're huge. What's the fourth thing? Our taxes. I already asked you guys, do you pay enough taxes? Are taxes going up or down in the future? I don't have a crystal ball, but if you go to usdebtclock.org, our government doesn't produce money. And if our debts are going up and up and up and up, guess who's going to foot that bill? You and me, footing the bill for Uncle Sam. So taxes, most likely growing up in the future. Again, no crystal ball. So if I'm wrong, I would guess the next thing they would do is just tax us on more things. And finally, what do you know about your retirement account? I got this handsome looking Uncle Sam here, right? We all know and love our Uncle Sam, don't we? So imagine Sam coming into your world and saying, hey, I'm going to use you again, Don. Hey, Don, let's you and I go into business. But here's the arrangement. Don, you're going to provide all of the capital, all the money, and I'm not going to contribute anything, but we're going to be equal partners. And Don's saying, well, I don't know, Sam. I'm not so sure this sounds like a good deal for me, but okay, I've known you for a long time. You've kept me safe. It's been a pretty good relationship. And then Sam tells Don, and Don, as you build this tiny little seed up to the great big harvest for the future over this period of time, I'm going to control how you can utilize that money that you worked so hard for. I'll tell you when you can access it, how you can access it, what the penalty is for accessing it early. Now Don's starting to think, I don't know. This didn't sound so good, Sam. And finally, Sam's last statement, his third statement, the final statement is, Don, when it's retirement time, or as Nelson calls it, passive income time, I'm going to walk back in and I'm going to tell you how much you have to pay me. It might be 20%. It might be 35%. Maybe it's 40%. Heck, maybe it's back in the 40s where it's 70+%. And then puts his hand out and says, okay, Don, let's be partners. How many of you would partner with Uncle Sam? Nobody, right? You'd have to be crazy to take that, but we do. And I don't know why. I did it. I used to put, the majority of what I was able to into a policy every month, or not into a policy, sorry, into my 401k every month, the maximum for years and years and years. And I never understood it. And so that's the partnership we have where the money is locked up, not accessible. Now there's good things about it, but I'm just saying, start thinking about where your money is going. So if any of this shook you, if any of this made you uncomfortable, just know that you're not alone. You're just starting to grow. You're starting to think differently. And that's all I'm asking from anybody here is just start thinking about money differently. So let's talk about this method. I promised you a simple methodology, a simple frame for how you can apply this concept, the infinite banking concept, by changing just the one thing. And this is what the wealthy and the banks have been doing for ages. So let's talk about the steps. Let's talk about this machine to keep your money flowing. That's the first step, the machine. The second is the marathon. You guys saw earlier and about me. I don't run marathons unless I've already ridden at least 112 or 116 miles on my bicycle, right? And so I want you to know the first principle of this concept is thinking long term. And that means in decades versus in weeks and months and hours. We're now thinking in terms of decades and centuries. We're thinking about the next generation. But we're also setting this up to be more successful in our first generation, especially if you're a first generation banker like myself. And then everyone's favorite topic, or perhaps, is being a millionaire. Maybe not just a millionaire, maybe it's a multimillionaire. Maybe some of you want to be a billionaire. But this is the method, the thinking that will get you there. Because wealth isn't linear, it's exponential. And so we're going to talk about this as we go through. So let's talk about this machine. What is this magical machine, Jason, that you're talking to us about today? Well, folks, it's nothing more than a dividend-paying whole life insurance policy from a mutually owned company. And you're probably thinking, Jason, what the heck does whole life have with wealth? Well, this is what the rich, the elite, the wealthy use. They use this vehicle. There's a great article by Ernst & Young who say that you should have 10 to 30% of what you earn going into whole life as an alternative asset. And are they doing that because they're stupid? Or is it because they maybe know something that we don't know? And it's just as important that we're going to tell you what we're not talking about. Because some of you might be driving, working, half listening, but we are not, NOT, talking about indexed universal life, variable universal life, or term. They all might have their place, but it is not in our banking strategy. And why is that? Because one, term doesn't build cash value, but the others that may or may not build cash value put you at risk. And do any of us want to have more risk than we already have in our life? I know I don't. As a father of two, as a husband, as a business owner, I don't want to have any more risk. I take on plenty as it is. And so now let's do an exercise together. You guys might be halfway through, maybe a little less, but let's do a fun interactive exercise. Let's look at how we've been programmed to give up control of our money and where we put our money first. So we're going to do this chart together. It's a T chart, and we're going to write the bank in the top left and policy in the top right. I do this almost daily on the calls I have. Underneath both, I'm going to write the word liquidity, or you're going to write the word liquid. And liquid for me just means not locked up in financial prison. It means accessible. It means I can get at it right away. How fast can you access the fund? Exactly, Amanda. Exactly, Darylyn. Instant access. And my cheekier version is just, it's not locked up in financial prison. Just write 0.07% down. That's being generous right now. I think it's actually lower than this. This is what the bank's giving you on your money. Now, under policy, you can write 3.25%. That's your first guarantee, right? Out of two guarantees, that's your first guarantee. And that's uninterrupted and compounding. This is the third law of wealth right there. Now, under bank, it's taxable. Any of that growth on that amount, whatever the amount is, it is taxable growth. Under policy, it's tax-free. The correct term is tax advantaged, But what am I talking about with tax-free? Tax-free growth, tax-free loans, and tax-free distribution. And then in our bank, we have unstable. Jason, what do you mean by unstable? Banks seem pretty stable. What about the, FDIC insurance, the 250 that they insure up to? Well, what I would say is remember the beginning of 2023, the Silicon Valley Bank, a $204 billion failure. And shortly after that, we had Signature Bank, another $100+ billion. They're in the top 10 of the last few decades as biggest failures from a bank. But they're not alone. In 2008, 2009, there was 364 bank failures. Do you know how many mutually owned dividend-paying whole life companies failed during that period of time? 0. Well, why are the banks failing would be my next question. Being curious, I just want to know, why are they failing? Well, they practice what's called fractional banking, meaning that when we deposit money, they're only keeping 10%. So for instance, if we put 10 grand in, they're only keeping 1,000. The rest goes out in motion. And they keep lending that over and over again until they multiply that by 10. This is where inflation comes from fractional lending. It's from our banking system, a lot of it, the majority of it, that and printing money. And now under policy, we have stability. And what's my definition of stable? Well, my definition is all of the 5 mutually owned companies that we work with, right? They're all dividend paying whole life companies, have all been profitable every year they've been in business. And all 5 of them are well over 100 years. For this example, it's 148 consecutive years. Now, I don't know about you, but that's pretty impressive. I'm feeling pretty good about having profitability for the last 148 years. And why is that? Well, they practice a different economy. It's called Austrian economics, which means that the money is backed by something, almost like going back to the gold standard in 71, right? Where we could turn $1 in for either gold or silver. It said so right on the bill. Well, now with the banking system that we build or you build for yourself, the privatized banking system, you borrow against the money. So you collateralize it. So you're never borrowing unless there's $1 of cash value in the policy already. And so in the next line under bank, we have unprotected. What do you mean by unprotected? Well, if you're a business owner, how many business owners do we have here today? But if you're a business owner, or maybe you own a rental property or something else, if someone gets hurt and they have a case against you, a good attorney can get at the money in the bank through liens and judgment. Whereas on the policy side, you're protected. And if you live in the great country of Florida like I do, you're fully protected. You're okay. And so far, if we're looking at the left side versus the right side, on the right side, we have guaranteed, uninterrupted, tax-free growth away from Uncle Sam in a stable environment, protected from those attorneys all over the billboards, and accessible, not locked up in prison. So far, we're looking pretty good on the right. Now under bank, they were the living benefits. Now we're going to talk about the cherry on top. With bank, there is no cherry on top. You have 50 grand, 100 grand, 10 grand, $1 million, whatever's in the bank. When you draw that money down and use it, do you get anything additional? No. But under policy, you have the second guarantee, which is a tax-free death benefit. That's going to be a multiple of whatever you've deposited into your system. And so now if we're all like, I'm promoting all of you, or maybe demoting, I don't know, depending on where you're at in life. But now we all sit in the executive team, or we're now contractors with a bank. They bring us into our bank and they ask us, hey guys, where do you think we should store our money? Our money that has to be stable, that has to be guaranteed, it has to be liquid. And where do we want to store the money? Are we storing it in our own banking system, or are we storing it in the policy? And again, don't believe what I'm telling you. Look it up. Since 2012 or 2013, banks have 4x'd, quadrupled the amount of whole life insurance they bought. If you've ever wondered why there's so many executives, VPs, and directors at a bank, now you know. As of Q2 of last year, they had over $225 billion of this stuff. Is that not nuts? That's a lot of money. A lot of money. So now the question for all of us, where do we want to store our opportunity fund, our rainy day fund, our money for the what ifs in life? On the left side or the right side? Where would we be more optimal storing our money? Pretty easy, right? And so now here's the one, you guys, as the banker in the last scenario, I'll be the banker in this scenario as well. And let's say, does anybody here need a new car? Do I get any volunteers that needs a new car? All right, Amanda needs a new car. So Amanda, thanks for volunteering. So Amanda is going to come into Jason's bank. Yeah, that's right. I own a bank. I'm pretty big stuff. She's going to come in and she's a saver, Amanda. She works hard. She's really has her eye on this new vehicle. Now, whether, the vehicle is going to be $25,000, $250,000, just add or subtract the zeros you need. Maybe you're riding a Matchbox car, $2.50, but just add or subtract the zeros. The math will still work the same, okay, for the kind of car. But Amanda comes in and she starts saving at my bank. And I love it because Amanda's disciplined. I'm getting my money on a regular schedule, and I'm giving her 4%. Forget the guy getting 3.5%. Amanda's now getting 4%. And I say to Amanda, when she comes in to tell me that she's going to get a new car, I said, Amanda, don't do that. She's like, Jason, why not? You see how hard I'm working. You see me coming in here and paying myself first, creating a margin, storing my money for the future. I said, I sure do. You have great discipline. But here's the thing. If you continue to leave your money in my bank for the next 5 years at 4%, I'll give you a loan for 6%. And over that period of time, you will make money. How many of you think I'm telling Amanda the truth? Am I taking advantage of Amanda, saving her money at 4? She's paying me 6. Who's winning in this equation? All right. Wow. You guys think I'm telling the truth. I like it. Either you've seen this before, you guys are really smart, because most people would say, no, you're negative 2%. If you're thinking, no, you're negative 2%, that's what I thought for the first multiple times that I saw this. But then I started doing the math, right? Math's not going to lie to us. The payments at 6% for 60 months for that vehicle, $483 a month, future value, $28,999. But if man just left the money sitting there, she'd have $30,525. So I don't know how you guys do math, but in Florida, I'm pretty sure that 30,000 and change is more than 29,000. So I was telling the truth. Amanda made $1,526 and had a vehicle and had a new vehicle that she paid for. Now later, I'm going to show you how this can get even better, where you control and keep even more of the money. And eventually you make money on your money. So again, whether you want a Focus, a Ford Focus, or a Ferrari, either way, you've seen that we have to stop looking, or we want to stop looking at the interest rates. We got to look at what the cash flow is in this scenario. So now that we've established that I'm an honest banker and you guys trust me, now you're all going to use the bank of Jason. And you're going to come in and you're going to put $100,000 into the bank. And immediately you might say, well, that's a great asset for you, Jason, as the banker. But is it? No, it's actually not. Because I'm giving you 4%. So guess what I have to do with the $100,000 or the money that you just deposit in the bank? I've got to put that money to work, right? If I don't put that money to work, nothing's going to happen. I can't pay you to 4%. It's a liability to me. So I'm going to have to give you the 4% from my own money. I'm not going to do that. I'm going to put your money to work and pay you from your money. And so what do? I lend the money out to a new home buyer, and they buy this big, beautiful home. And now that money has to be stored somewhere. Where does it get stored? That's right. It comes back to the bank. It goes out and it comes back. Watch this little elliptical motion that we have going on. You're going to see this a lot. Probably looks like a flower if you saw me tracing it. But now this new homeowner, got this beautiful home, and you can't drive or park a beater in the driveway. No one wants to see that in this new neighborhood with the expensive HOA. So you go buy a blue BMW to match it. And that money also has to come back somewhere. Where does it come back? Back to the bank. And now you got the new home. The kids are like, I want a pool like the neighbors. Look, they all have pools. We're in Florida, Mom, Dad. We need a pool. All right. So now we take what? We take a home remodel or a home, line of credit out, and we take the money out, and now the money's got to come back somewhere from the contractor. It comes back to the bank. And the bank does what? They move the money again. Now with this new home and the BMW and the pool, now we need pool floats. We didn't think about the service. We didn't think about all the other things. And now we have a bunch of debt that we didn't have 2 years ago while we were saving for this home. Pretty common, right? And now we do a debt consolidation. Over this period of time, the bank continued to hold up their end. They never fluctuated it, which wouldn't happen in real life, but you still got 4%. And now let's look at what the banks made in each of these money movements. Just think of these as money movements. The bank's taking our money and they're going out to make money with it. Small money movements. So in the first one, the bank made 3. The second, they made 4. The fourth, 9 minus 4 is 5. I know, pretty impressive math. 12 minus 4, 8. And when we add all of these up, it's 20%. How many times bigger is 20% than 4%? Is it 16% bigger? No, right? It is 500% bigger. The bank made 500% on every dollar that you deposited into the account annually. Would you guys like to know how to do that? If you've already seen enough here, you already know like, oh my God, Jason, I'm new here. This is crazy. Are the banks really making that much money on my money? Yes, they are. I'm going to show you where you can go look this up. Remember, don't believe what I'm saying. But if you already love what I'm telling you, make sure you're smashing the like button, subscribing to the channel, scan that QR code, have a conversation with me. Have a conversation and I can have you financially weigh in and show you a better way to use your money to create more money. And like I said, go look up your bank at bauerfinancial.com. Take a minute, take 10 minutes, go scroll around. I've never seen a bank making less than 400% annually on our money. And so this is something that we all want to know. And this is why privatizing our banking by changing that one thing is so valuable. When we go to the bank and we deposit our money there, what do they have next to the stand? Usually a little thing of lollipops. And what do they say on the wrapper? Dum dum. They're telling us all the time. They're telling us what we're doing is not what they're doing. Remember, the rich and the wealthy are playing different games. You're just learning the rules here with me today. Let's look at how we in America, all of us, have been spending money since the 1960s. This pattern of spending has not changed almost at all. I'd say actually we're paying more for automobiles. So for every dollar we make, we spend 20 cents for automobiles, 30 cents for housing, 40 cents for everything else. And now I'm going to be super generous because we're at 90%. We're going to say that other 10% is what we're saving. Well, I can tell you as of last month, or at least as of June of 2025, Americans were saving less than 5%. I think it was 4.9%. Since 1985, I don't think we've ever, other than during the pandemic, saved 10%. And what's the first law of wealth? Pay ourselves at least 10%. So that's what we're doing here. We're being super generous. We're saying we're paying ourselves 10%, but we know that's not really happening in the majority of households. Now let's look. Remember how I told you that when we have debt, it feels like we're on the bottom of a teeter-totter, right? Or we're at the top and we got a gorilla at this end. How do we swing it the other way for ourselves? Let's look how we can give ourselves a 35% raise. So at first, for the car, we're paying about 5 cents of every dollar for that car. So if we transfer that back over to our savings, that puts us at 15%. Now, if you bought a home, how many people here have bought a home in the last 5 to 7 years? I want you to like me. So whatever you do, don't go home today and look at your statement and see how much interest you're paying compared to the principal. With our homes, for the banks know how often we move, every 5 to 7 years. So those first 5 to 7 years, we're paying 70 to 80% towards interest. So 25 cents of every dollar, of every 30 cents is going towards interest on the home. Let's move that back over. Now it takes a little bit of time at times, but I'm going to show you a real client example coming up. And finally, everything else. This is our credit card. So we're probably 5% is really not accurate, but we're going to move that back over. And now the savings went from 10 cents of every dollar to 45 cents of every dollar. And you might be saying, well, Jason, I can't do that. Like I have bills. I get it. But when we have a system, a process of taking back control of our money, it's really this volume of interest that's keeping us from having the things that we want to have. It's that little bit of delayed gratification because now we have that annual pattern spending looking that way. we have that opportunity. So here, everything I'm telling you is an opportunity to recapture and recycle that money. So next, we're going to go and show you, like, how do you all buy your vehicles, right? I'm going to show you a better way, an alternate way to finance all the cars that you ever buy, drive, and own. Now, I know the majority have either bought your vehicle, you can put a B for bought with cash, you have financed it, so an F for finance, or, right, maybe you leased it, so an L for lease, if you want to pop these in the chat so everyone can kind of see how you got your car, or maybe an S for stolen. Maybe you stole your car. I don't think that's anybody here, but just in case, those are the 4 ways that most people traditionally are getting their vehicles. They're buying, leasing, paying cash, or stealing. Well, what if there's another way? What if there's a way where that you could get all of the interest back for all the cars that you ever buy, drive, or own? Would you want to know how? Would that be valuable? And let me show you how to do that. And so this is looking under the hood of the machine. And now, remember, I've already said this a few times, we're going to look at the deposits into our system as premium deposits, because when we get paid and it goes into a bank, what is it? It's a deposit into our account. That's what we're doing. We're building up your opportunity fund. And so whether, we're not going to tell you how much you're going to put for your premiums. And another thing is your age doesn't really matter, whether you're 21, 41, 51, 61, 71 years old, the system can still work with you as long as you're healthy, as long as you have good health. And it'll work very much the same from 21 to 71. And we can show you what that looks like. And finally, this is super important to myself as a father of 2, but the death benefit isn't the focus. That is the cherry on top. So we're not going to talk about that when we talk about financing or an alternate way to finance all the things we buy, drive, or own. And so let's look at this. We'll go back to, Anna from earlier. She was a really good buyer of a car, good saver. So we're going to use Anna again. Now she trusts me. Now we're going to set up Anna's own banking system, her privatized banking system, especially engineered, cash rich, whole life policy for Anna. And what's Anna going to do? She's going to put 10% of what she makes, or she's going to put at least $10,000 a year into the deposits, the premium deposits. And she's going to stack that money 1 year, 2 years, 3 years. And then she's going to take a loan and she's going to go buy that car with her own system. And then what's she going to do? Remember before it was 483. We're just rounding up to 500 because why? It's Anna's system. She's going to pay herself back. She's going to pay herself back the money, because if it's our bank, our system, don't we want to be an honest banker? And that's what we teach you. We're going to teach you, if you believe like I do, the wealthy have more choices. So I'm going to show you the multiple ways, the multiple control that you have over paying back your system. But for this example, Anna's just going to pay it back monthly. So $500 a month times 12 is $6,000 a year. And she'll do that for the next 5 years until the loan is completely repaid to her system. Now she's contributed $100,000 into the system, right? Because she was going to pay someone other family the $500 a month. So she just turned that money back to her system. Remember that, because everyone's always like, I don't want to take a loan. I just want to pay cash for it. But watch what happens here. She put $100,000 in, has $25,000 that went out for the loan, a net of $75,000. And look, she has $67,000 still of cash value. But Jason, how's that possible? Well, I'll show you in a moment. But first, we're going to do something crazy. You guys want to get crazy? We're going to put nothing into the policy for the next 5 years. But now Anna's car has gotten a little beat up. Some spills, maybe some food stains, maybe some pet stains. And so it's just time. It doesn't smell like a new car anymore. And she's ready for the new car smell, ready for that fresh feeling. And so she's going to go buy another car using her cash value. But this time she's made no deposits. But like we teach, we still want her to be an honest banker. So now she's going to pay herself back the $500 a month for $6,000 being paid back, and took a $25,000 loan. And now at the end of her time, look what happens. Now it's an outlay of $5,000 total, right? Because she's paid $30,000 back, $25,000 loan. But look, her cash value has grown an additional $23,000, even though she didn't make any more premium deposits into her account after year 7. I would never recommend this because if you handed me $1 and I handed you 2, how many dollars do you want to give me? But just to show you that there's a better way to finance your vehicles, let's go through the rules. What are the rules you have to follow? Rule number 1, is you gotta pay yourself first. It's the first law of wealth. And I put there a little dramatically, as if your life depended on it. Because why? It really does. Your financial future and freedom depends on you paying yourself first, whether you use this concept or not. Number 2 is you want to pay yourself with interest, because our reality is we finance everything we buy. We either pay interest or we earn interest. There is no third option. And finally, we want to recycle and recapture our money. You know, the more that you're able to deposit into this account, the more that you're paying yourself back, you're recycling and recapturing the money so you can use it again and again. Because guess what? As Anna was building back that opportunity fund in the policy, paying herself back, it was giving her the opportunity to use the money again for the next vehicle. And guess what? She never interrupted the compound interest. And oh, by the way, it had a death benefit. So now she gave $1 3 jobs, saving it, spending other people's money. That's the money she's borrowing as a loan, tax-free, and protecting with the same dollar. So if this works for our car, what else can this work for? Anything. After seeing this very presentation, we had one of the Kairos, one of our docs, come up and say to Chris Naugle, you know, one of my peers, partners, said, Chris, hey man, great presentation. Can you help me? You know what Chris said? The same thing we say on Ask Me Anything every week. It depends. Doc, show me what's going on. Like, what debts do you have? What money's leaving your family on a monthly basis? And then I'm going to ask you, after we go over the debts, you know, looking at the bad debts, that defined as money not making you money. Well, then we're going to look over the assets. And so we went through the doc's debts. Now he's 45 or 46 years old, I forget. And he has $478,000 of debt, you know, including a house and a condo. And he's paying about $69,000 a year in principal and interest to these third parties. Now remember, the banks, these systems are making a pretty good living off this doc. Now he's not making a bad living. But our next question is, well, Doc, do you put money into a qualified plan, right? Do you have Uncle Sam as a partner? And he said, yeah, I do. I put about $25,000 a year into my qualified plan. And Chris asked him, Doc, would you be willing to change one thing? How many things all? One thing? Change one thing. He said, yeah, I would if it could get me out of this debt any faster. And we said, well, yeah, it can. So let's look and go through this real life example. Remember, I am looking to help you make something that is super boring, whole life insurance, really sexy. So let's dive into this. So he agrees to take the $25,000 that he was putting into a qualified plan and locking it up into one of these specially engineered whole life policies. In year number 1, he deposits the money, has about $14,000 to take as a tax-free loan. And what's he do? He pays off Discover and Lowe's, recapturing the money leaving his family of $448 a month. Not bad, right? That's an additional close to $6,000 in year 1 coming back. So now in year 2, he makes that same premium deposit, and look what happens. The cash value has went up. He's paid himself back as an honest banker and stored that money. And now he's going to take that $21,000 and he's going to pay off the next 3 things and pay down the Beamer. Remember the blue Beamer? Now the doc's freed almost $2,000. We're talking 2 years, a $24,000 increase back into his system without working any harder, working any longer by changing one thing. Not bad, right? Let's look at year 3. Same amount of money in, and something really cool happens. We hit an efficiency point. This can happen somewhere between years 3 and 6, sometimes sooner, but it's what I define the efficiency point as is every dollar you're putting into a machine can give you more than $1 back. And so now we have the cash value, the payments back to himself, pays off the beamer, pays off the boat. Now he's recaptured more than half of the money, and we're only 3 years in. The honest banker payment is now $3,677 per month coming back to this doctor's wheel of wealth or personal economy. And then we go to year 4. But first, let's review the marathon. If we put $25,000 in for 3 years, we've deposited $75,000 into the policy. If we take loans of $14K, year 1, $16K in year 2, $25K in year 3, we borrowed $55,000. Doesn't this mean that we should have about $20,000 left in the policy? Is that correct? No, wrong. It's not $20,000 left. Remember, we're collateralizing, borrowing against the money. We never interrupt the compounding. All $75,000 we deposited is still in the account. The cash value is still there, earning you a guaranteed interest rate and most likely an additional dividend. So in year 4, same amount goes in, look, it grows again. Every year it gets better and you can't do anything about it. It just gets better and better and better. It's guaranteed. It's on the contract. And guess what? Now this doc's paid himself back more than he even put in the policy because he's being an honest banker. Now he takes that $70,000, doesn't pay off the condo yet, but reduces it. The home's still there. And we go to year 5. Just like before, same deposit, money grows again, more cash value. And now you knock that debt of the condo out, you knock the debt of the house down, and you're still making those payments of $45.56 back to your system. 5 years in. Remember how long it took before? 19, right? Well, year 6, something else cool happens. Think about this. If you're a business owner and your business gets to running super efficiently, where it's just like a cash cow, money is just being created and printed on a regular basis, what are you going to do? You're going to replicate it, right? You're going to expand your system. So that's what happens to this doc. His policy got so efficient from the money that he's putting into it year after year that he couldn't put any more back into it. So, he couldn't put anything additional back into it. And he had all this money coming in. So he said, you know what? I'm going to protect my family more. I'm going to start a second policy. I'm going to expand my warehouse of wealth. So he puts 10 in the first policy, has 13,000 of tax-free money for a loan, puts the same amount, 25 grand into policy number 2. Now he has the cash value, same as before for policy number 2, pays himself back 54 grand. And look at this. 6 years in, the doc has paid off all of his debts. So just to review, coming in, he had this $400,000 plus of debt, $57.77 a month leaving him. And this was going to be the case for the next 19 years. By changing one thing, the doc has now paid himself all of the bad debt off, recaptured it all back to his system, and now he's going to build up that opportunity fund again to put that money to work for other things he might finance, or more optimally, his money is going to go make him money. And how many of you would think it'd be valuable if you could have a roadmap of this? You had a strategy call, you schedule a call with myself. I walk you through, how you can pay yourself first, where you're going to store it. We come up with your specially engineered plan. And then as you're going through underwriting, as you go through the application process, you meet with our team and they show you what's the most mathematically efficient way to pay the debt. Is it going to be the snowball, the avalanche, the high interest first? Which one mathematically will give you the best and quickest payoff? We'll show you that. Then we'll show you what it looks like to put the specially engineered policy on top of it. How many months does it take to get out of third-party debt? How many months to pay yourself back? And then guess what? We can even talk to you about once you pay yourself back, where are some places that you can go learn how you can go multiply that money. That's the next step. So progress equals happiness. I want you to pause for a moment and we've been at this for a while. You've seen walls of numbers. So little joke, how do you eat an elephant? Right? You eat an elephant one bite at a time. You don't start at the ears, too big. Start at the feet and work your way up. You're going to make lots of elephant dishes, stews, steaks, burgers, salads. And like I always say, no elephants were hurt filming this. And did the man or the woman at the top of the mountain fall there? No, they had to get there, one step at a time. And the progress we've had together today is already enormous. So celebrate, high five yourself again, take a moment, high five me. We don't make progress unless we've fallen down. We don't make progress unless we're honest with ourselves and actually weigh in. And if you don't have debt, all the more reason to have an opportunity fund to go do an and both decision. And so now that we're here, it gets better. Remember I told you I'd map out the millionaire mystery? You thought I was wrapping it up and landing, but no. The third principle, don't steal the peas, right? The condo, the house. If that doc just kept paying himself back for lots of months, for years, look how much he recaptures, almost $500,000. But wait, it gets better. Remember, now it's in an environment where it's earning guaranteed interest every year. Now we're at $750,000. And we're not even talking about the money that could be made by using the money back into his system. We're just talking about changing the one thing. This is how you map out the millionaire mystery. So now that you know this, if you don't, whether you're making $10 an hour, $10,000 an hour, it doesn't matter. You need this. The Rockefellers, the Rothschilds, the Morgans, the Stanleys, the Barclays, they all understood how to keep money in their family, how to do family banking, the infinite banking concept. And so by breaking the bonds of financial slavery that you don't even know you're in, by changing the one thing, but you're letting money leave your family right now. So now that you know this, if you don't take action, remember, knowledge doesn't get you anywhere. You have to apply the knowledge, apply the information, put action behind it. When you apply this knowledge, you are not only serving your family, which is why you're here today, and yourself, but also your great-grandkids, your grandkids, and so on and so forth. If you don't do it, then you're stealing from them. And so, as Warren Buffett said, if we want to be wealthy, if poor people would just do what rich people do, they wouldn't be poor anymore. Well said, Warren. And so I got bad news for you. Only one of two things is going to happen to you. Sorry to end this on a down note, but you're either going to live or you're going to die. Are you better with or without this system? And so together, we just learned a lot. We learned how the banks make 400 to 1,300% annually on your money. That's just nuts. How many of you would like to make that kind of return on your money? We showed you how to turn your debts into assets, a better way to finance all the things that you're going to buy while keeping control of your money and protecting your family. That's the power of becoming your own banker, the power of privatizing your system, building your opportunity system. And you know what the most common thing that my clients tell me, the 3,000 plus people? Jason, I wish I would have known about this 20 years ago. And if you still think that this is unattainable right now, I promise you, this is within your grasp. It only takes you spending a little bit of time financially weighing in, understanding what it is that you want long-term and bringing that back to the current. And so here's the crazy thing about this. Do you know who already knows about this? Rich people. And I guess they just didn't give the rest of us the memo. So ladies and gentlemen, welcome aboard. You are now the wealthy. You now know how they built their foundation, how they build their empires, and you understand that you can either keep learning about this and not applying this knowledge, or you can take action. Scan my QR code, book a call with me, and have a conversation around this simple principle.